Inflation in India. Inflation is the general increase in prices of goods and services in an economy over a period of time, resulting in the decrease in the purchasing power of money. In India, inflation is measured using various indices. Consumer Price Index, CPI. The CPI measures the average change in the prices of a basket of goods and services consumed by households. It is used to monitor changes in the cost of living for the general population. In India, there are separate CPI indices for different groups, such as CPI for industrial workers, CPI-IW, CPI for agricultural laborers, CPI-UL, and CPI for urban non-manual employees, CPI-UNME, among others. Wholesale Price Index, WPI. The WPI measures the average change in the prices of a basket of wholesale goods. It is used to track price movements at the wholesale level and is often used by policymakers to monitor inflation in the manufacturing and production sectors. GDP deflator. The GDP deflator is a broader measure of inflation that reflects the overall price level of all goods and services included in the gross domestic product, GDP. It provides an indication of inflation in the entire economy. Inflation rate. The inflation rate is the percentage change in the price level over a specified period, usually measured annually or monthly. It is calculated based on the CPI, WPI, or GDP deflator, depending on the context. Types of inflation. Demand pull inflation. This type of inflation occurs when the overall demand for goods and services in an economy exceeds its supply. When demand outstrips supply, prices rise, leading to inflation. It is usually associated with periods of economic growth and increased consumer spending. Cost push inflation. Cost push inflation is driven by rising production costs, such as increased wages, higher raw material prices, or taxes. These cost increases are passed on to consumers through higher prices, leading to inflation. Stagflation. Stagflation is a rare and challenging economic situation characterized by stagnant economic growth, high unemployment, and high inflation simultaneously. It presents a difficult policy challenge for policymakers as traditional approaches to tackle inflation and unemployment may not work effectively together. Structural inflation. Structural inflation occurs when there are imbalances in the economy due to factors such as supply-side constraints, infrastructural bottlenecks, or persistent government policies that lead to sustained inflation over the long term. Deflation. Deflation is the opposite of inflation, where the general price level of goods and services decreases over time. This can be caused by a decrease in demand, technological advancements leading to lower production costs, or other economic factors. Disinflation. Disinflation refers to a decrease in the rate of inflation. In other words, prices are still rising, but at a slower rate compared to previous periods. The cost of inflation. Inflation can have both positive and negative effects on an economy and its participants. Positive effects. Debt relief. Moderate inflation can help borrowers because they can repay their debts with money that has lower purchasing power, effectively reducing the real value of their debt. Boost to asset prices. Inflation can lead to higher prices for assets like real estate and stocks, potentially benefiting those who hold these assets. Negative effects. Purchasing power erosion. Inflation erodes the purchasing power of money, meaning consumers can buy fewer goods and services with the same amount of money. Uncertainty and reduced investment. High inflation rates can lead to uncertainty in the economy, making it difficult for businesses to plan and invest for the future. Fixed income groups. People on fixed incomes, such as retirees, may suffer from a decrease in their standard of living as their income may not keep up with rising prices. Inequality. Inflation can exacerbate income inequality, as different income groups may experience varying levels of impact on their purchasing power. Interest rates. Central banks often raise interest rates to combat high inflation, which can lead to higher borrowing costs and potentially slow down economic growth. Causes of inflation. Monetary factors. One of the primary drivers of inflation is an increase in the money supply in the economy without a corresponding increase in goods and services. When there is more money available to chase the same amount of goods, prices tend to rise. Cost push factors. As mentioned earlier, rising production costs, such as wages and raw materials, can push up prices, leading to inflation. External factors like global commodity price fluctuations can also contribute to cost push inflation. Demand-supply imbalance. When demand exceeds supply, it puts upward pressure on prices. This could be due to factors like rapid economic growth, increased consumer spending, or supply disruptions. Exchange rate changes. If a country's currency depreciates against other currencies, it can lead to higher import prices, which can contribute to inflation, especially for goods heavily reliant on imports. Inflation expectations. When people expect higher future inflation, they may act in ways that perpetuate inflation, such as demanding higher wages to keep up with expected price increases. Effects of inflation. Redistribution of wealth. Inflation can lead to a redistribution of wealth from savers to borrowers, as lenders may receive lower real returns on their savings, while borrowers benefit from paying off debts with cheaper money. Menu costs. Businesses may incur costs in adjusting their prices frequently to keep up with inflation. These costs are known as menu costs. International competitiveness. Persistent inflation can erode a country's international competitiveness, as higher domestic prices can make exports less attractive and imports more appealing. Central bank response. In response to inflation, central banks may implement contractionary monetary policies, such as raising interest rates and reducing the money supply, to curb inflation. Measures to control inflation. Monetary policy. Central banks use monetary policy tools to control inflation. Raising interest rates is a common measure to reduce consumer spending and borrowing, which can help cool down the economy and bring down inflation. Fiscal policy. Governments can use fiscal measures like reducing government spending or increasing taxes to manage inflation. Supply-side policies, addressing structural issues in the economy, such as improving infrastructure, removing bottlenecks, and enhancing productivity, can help reduce cost-push inflation. Wage and price controls. In extreme cases, governments may impose controls on wages and prices to directly limit inflation, but such measures are often temporary and can have unintended consequences.